everyone, welcome back to the FRTP compilation revision videos. Today we are going to start with in the years 41 agriculture. ABC Limited is in the business of manufacturing an apple beverage and requires a large quantity of apples to manufacture its beverage. In order to satisfy its requirement, it enters into a 3 years lease contract with the owners of the apple orchids. The lease contract are mainly of two types. Contract 1. The apple owner of the apple orchid raises trees to produce apples. ABC makes a fixed payment, okay, and it also harvested. Okay, then the owner of apple orchid is going to cultivate the produce. In contract 2, the ABC Limited obtains the apple orchid and raises the apple trees and subsequent harvest of the apple to ensure the apples as per the requirements of the ABC Limited. It also makes a fixed annual payment. Explain. Which is the agricultural activity. So, paragraph 5 of India's 41 agriculture defines agricultural activity as a biological transformation as follows. Agricultural activity is the management by an entity of the biological transformation and harvest of the biological assets for sale or conversion into agricultural produce or into additional biological assets. So it is a controlled biological transformation will be forming part of agricultural activity. Biological transformation comprises the process of growth, degeneration, production, procreation that causes qualitative or quantitative changes in the biological assets. Growth, degeneration, production, and procreation. See, for agricultural activity in this 41 question, these two definitions are highly important. Contract 1. See, in contract 1, during the 3 years of the contract, ABC only harvests the apple. Okay, it does not is not involved in the but actually there is no controlled biological transformation. This undertaken by the entity. Since ABC Limited is not involved in the biological transformation of apple orchids and is only harvesting, it cannot be said as agricultural activity. Hence, it is not engaged in agricultural activity. Clear? I am not involved in the process of controlled biological transformation. That's why this will not be forming part of agricultural activity. Contract 2, as per the contract, ABC Limited obtains the apple orchids and is involved in raising the apple trees in order to ensure the apples are as per the requirements and is actively managing biological transformation and the harvest of the biological asset. It is said to be engaged in the agricultural activity. Since I am engaged in the controlled biological transformation of the apple trees, so that's why I will be known to be engaged in the agricultural activity as per in the years 41. So this only one question was there in the RTP, so that was also we have completed now. Let's move on. Right, so the fair value of the plant assets was 10 lakh. The plan paid a benefit of rupees 1 lakh 10,000, received contribution of 4 lakh 90,000. The company computes the fair value of the plant assets to be 1 lakh 50,000 and the present value of the defined benefit obligation to be 14 lakh 79,200. The actual losses of the defined benefit obligation by 6,000. Compounding happens half yearly. This is going to be, see, these are the small points which have to be focused. Okay. The normal interest rate for 6 months period is 10%, while effective interest rate is as follows. Interest 9.25, effective rate of return is 10.25%. Determine the actual return and the expected return on the plant assets. Okay, first, computation of expected return. What I'm going to do, return on 10 lakhs at the rate of 10.2%, 10.25%. Then return on 3 lakhs for 6 months at the normal rate. Return on 3 months for 3 lakh for 6 months at the normal rate. See here. How is 3 lakhs? 3 lakh inflow, that is 4 lakh 90,000 minus 1 lakh 90,000. 4 lakh 90,000 minus 1 lakh 90,000. Okay, that is not a net return. Okay, then fair value of plant assets 15 lakhs. 10 lakhs is the fair less the beginning fair value. Contribution received during the year is 4 lakh 90,000. Benefits paid during the year is 1 lakh 90,000. So actual return on plant asset is 2 lakh. Expected return is 1 lakh 17,500. Actual return is 2 lakh. So I have an actuarial gain of 80 to 500, but I have an actuarial loss or defined benefit obligation given. So net actuarial gain would be 76,500. Simple question. You have just to apply the things which have been given in the question. Okay. Now let's move on. Here. See, this one is quite big question. Let's see it. Okay. Just heavy equipment for construction industry. An order for supply of 90 equipment was received from ABIL. So HBCL is going to manufacture heavy equipment. An order for 90 equipment was received from ABIL. The unit price is 190 lakhs each. 190 lakhs each. 64 equipment is supplied in 20x1, x2 and balance quantities we applied on 31st March 20x2. HBL as a requirement has 5 equipment in its inventory. HBL considered the contract was an onerous contract and therefore the net realizable value of the inventory has been taken as the value of the inventory as on 331 X2. The management of SPCL contains the cost incurred towards administrative overheads finance are considered as period cost and hence not considered as creation for provision. Hence the same have not been included in the computation of unavoidable cost. The management of HPCL has submitted the details of cost and have considered the creation of provision towards the onerous contract. Material cost includes the material procured, provided, everything. Okay, then labor cost, material overheads, then booked on a department linked with materials. Okay, then accordingly, provision has been made considering the above cost only. The value of the provision created for 21 remaining equipment to be produced. See how many I have been getting an order of 90. Okay, in that 64 have been supplied. 90 I have get an order of 90. 64 supplied. 26 is remaining. So I already have 5 in my inventory. So 21 is the balance. Okay. Then cost of production is 199 lakh. Selling price is 190. Differential cost of equipment is 9 lakh. For 21 equipment is 189 lakh. While the company's accounting treatment for cost of creation of provision towards the onerous contract is in line with the provisions of NDS 37. So let's check it. As per paragraph 68 of NDS 37, onerous contract is a contract in which the unavoidable cost of meeting the obligation exceeds the economic benefits received under it. The unavoidable cost under the contract reflects the at least net cost of exiting from the contract, which is lower of cost of fulfilling it, and any compensation for penalties arising from the failure to fulfill it. In there, 37 provides that amount recognized shall be the best estimate of the expenditure required to settle the present obligation, which is the amount the entity would rationally pay to settle the obligation at the end of the reporting period or transfer it to a third party at that time. In the case of onerous contract, any amount that an entity would rationally pay to settle an obligation would be the lower of the compensation or penalties arising from the failure to fulfill the contract and excess of the unavoidable cost of meeting the obligations under the contract from the economic benefits. As per paragraph 68 of Ind-AS 37, the cost of fulfilling a contract comprises the costs that are directly related to the contract cost, that are directly related to contract of both incremental cost and allocation of directly attributable cost. Unavoidable cost of meeting the obligation under the cost are only the costs that are directly variable with the contract. Therefore, incremental does not include the allocated or shared cost, cannot be avoided by the entity's future action. Accordingly, HVCL has correctly measured the cost of creation of provision for onerous contract by considering material labor and the material overheads directly related to the production. It is correct that the period cost will not be considered for measurement of cost for the purpose of creation of provision in onerous contract, as they do not relate to the fulfillment of contract. See, simple, as simple as that. Let me put it as simple in the simple manner. Okay. See, for the purpose of onerous contract, we have to take only the directly variable cost, okay, or the penalty cost, so incremental cost, or the cost of non-fulfillment. This, for example, could be penalty cost. So here the penalty cost is not given, so we take directly the cost of fulfillment of the contract. So this material cost, labor cost, and material overhead. Those are directly variable, and the other overheads which are incurred are considered as period cost and are not included in the cost of inventory. That's why the calculation done by the HPCL, I guess so, right? HPCL is very much proper as they have included only the costs that are variable in the calculation of onerous amount and not the period cost. Clear? So now let's move on. In the S12, income taxes. Okay, one big question. I think all the November 22 questions are quite big. I'm not sure about May 23. So let's see. Loss of Earth Limited as per the INDAS for the year ended 31st March 20x1 as per INDAS for 31st March 20x1. Revenue is this much. Okay, let's take revenue, other income, purchases, change, all things have been given, right? Additional information. Corporate income tax is applicable at the rate of 30%. Corporate income tax is applicable at the rate of 30%. Other income include the long-term capital gain of 10 crores, which is taxable at the rate of 10%. 30% general income tax and long-term capital gain are taxed at 10%. Penalties, impairment of goodwill, CSR expenses therein, other expenses which are not deductible for income tax purposes. Other expenses which include research and development expense of 8 crore in respect of 200% pay reductions available under income tax law. Profit before tax of 594 crore includes an agricultural income. You're right. It includes an agricultural income of 55 crores exempt from tax. 60 crores earned in USA, on which Earth Limited is required to pay a tax at the rate of 20%. Depreciation as per income tax law is 25 crore. During the review of the financial statements of Earth Limited, CFO multiplied the profit before tax and arrived 178 ST this much. Okay, however, actual tax expense appearing in summarized the profit and loss account is 166.90. CFO sought your help in reconciling the difference. CFO has sought your help in reconciling the difference. Here it is 166, but he's applying 594 into 30%. He's telling some other amount. Okay, now see, this sum is really worth, okay, because it takes into effect all the things which are possible in income tax. So I request you all, you listen to this video, or else please pass here, try it once, find where are you doing the mistake and then listen, or else if you want, you listen this first and then do it. At least once you do it before the exam. Okay, you cannot take chance here. Okay, accounting profit 594, accounting profit 594. What is the tax rate applicable? 30%. Is that it says that it is 178.20. 594 into 30% is 178.20. Now, tax effect of expense that are not deductible. Okay, penalties not deductible, impairment of goodwill not deductible, CSR not deductible. So one, see, 1 plus 44 plus 6 into 30%. I'm going to 15.3. 15.3 is the tax effect that is not deductible. Then deductible expenses. See, research and development, I'm going to get 8. So I have spent 4, but I'm going to get it as 8. So 4 into 2 into 30%. I guess what I'm telling is correct. Let me check it once. Yeah. See here. No. 200% reduction is available. Okay. Which means here they have assumed it to be, you can put an assumption that this is assumed to be the double amount. Okay, then tax effect of the income that exempted in the determining the taxable profits. So 4 crore is a dividend income. 4 plus 50 4 plus 55 into 30 percentage. It's nothing but 17.7 is again exempt. Okay, then this here alone, please write an assumption that this is the weighted amount I am taking it. Okay, then tax effects, differential income tax on long term. So here I've charged already as for 10 crore. I've charged as 30%, but I'm required to charge only 10%. So tax difference is 2 crores. And foreign income is taxable at 20% alone. I've taxed at 30%. 60 into 10%. It is 6. Okay, here it will be 8. So the net here after deducting all these, adding or deducting it, I will get 165.40. Then reconciliation of deferred tax is only for current tax, right? Then I'm going to do for deferred tax. Deferred tax in relation to depreciation and amortization. Deferred tax in relation to depreciation and amortization. 30 and 25, it is 1.5 crore. There's only 1.5 crore given in the question itself. Okay. So with this, we have also compared this one. Clear? Here alone, you have to write an assumption. Okay. If you're writing the other way also, please write an assumption. But if you write in the other way, you will not get this answer. Okay. That's why we are telling that this assumption has been taken. Okay. So 8 into, if you put it as 8 into 2 into 30%, then you will get 4.8. Here you will have a difference of again 2 point something, 2.4. Again, you will have a difference. That you will be worrying why this difference are coming. So it's better you go with this way. It's better to go with this way. Okay, then. In the S24, entity A owns a 30% share capital of entity B and has the ability to exercise significant influence. Entity B holds the following investments: 70% of share capital of subsidiary entity C, 30% of share capital in entity D with the ability to exercise influence. Entity A transacts with entity C and D. Should entity A disclose these as related party transaction? C. Entity A should disclose the transaction with entity C in A's separate financial statement. C is a related party because C is a subsidiary of A. Entity is A associate. Entity B. Entities A management is not required to disclose an A's transaction with D in its financial statement because it is enabled to exercise significant influence. See, let's make it very simple. Okay, no worries. Okay, I am owning 30%. So B is my associate, right? 30, so 70% in 70 percentage, I am going to own 30 percentage. In 70 percentage, I am going in 70, I am going to own 30 percentage, which is 21. Again, above the limits. That's why I'm going to exercise some significant influence. That's why I'm going to say it as my related party. But in 30, if I put 30 percentage, it's only 9 percentage. I'm not having any control. That's why I'm not telling it as related party. Clear, simple as that. Then company S as a subsidiary, this is with respect to EPS, as a subsidiary of company P. Following facts are in respect of company S. Company S has 10,000 ordinary shares, 1,000 share options outstanding, of which company P owns 9,000 shares and 500 options respectively. The options have exercise price of 40, average market price was 50, company's profit was 30,000, and company P has ordinary shares of 5,000, and company's P profit excluding the distributed undistributed earnings 7,000. The options are dilutive at P's level. Determine the diluted EPS, and ignore the income tax. Ignore the income tax. Make it very simple as usual. Okay. I don't know why it's not working. Just give me, hold on. Okay. Company S earnings is 30,000, right? Number weighted average ordinary shares is 1,000. So incremental shares is 200. Incremental shares is 200. How it is 200? Let's see it here. For the working note, right? We'll go way down. Okay. Assume excise the option. Everybody excise the option. Then it is 1,000. Okay. And shares that have been issued at average market price. This I'm general market price is 550, right? So 1,000 by 50 into 40, 800. Okay. Then incremental shares would be 200. Incremental shares would be 200. Incremental shares would be 200. Considering a dilutive EPS would be 2.94. EPS would be 2.94. Company P, 7,000 is the company's earning. Okay, company's P share of earnings attributable to the ordinary shares. I have 30,000 profit there, out of which I am responsible for 90 percentage. End. Okay, so simple as that. Okay, let me use the EPS. Okay, 2.94 into 10,000. Why is it? Because I'm going to get some more ordinary shares, right? So that's why I'm going to use the diluted EPS into 9,000. Sorry, 2.94 into 10,000. Okay, divide into 9,000 divided by 10,000. It is 26,460. 26,460. Okay, it will be earning here. See, it will be earning 2.94 for other 200 shares into 500 divided by 1,000. It is nothing but 294. It is nothing but 294. Okay. So to put it very simply, let me make it as 2.94 into 9,200. Okay, sorry. Okay, let's make this calculation itself. Okay. No, no, somewhere I'm getting something. Okay, sorry. Company's P weighted average ordinary shares is 5,000, and then company's P diluted EPS would be 7,000 plus 26460 plus 294 divided by 5,000, 6.75. 6.75. Clear? Let's move on. In the S108 operating segments, I have these external sales, I have intersegment sales, I have total sales, segment profit, and segment assets. Segment assets. Okay. Now, identify the above segments out of A to H, which will be considered as reportable segments. Identify segments which will be considered as reportable segments. Okay. So, percentage of total sales, if I take it as only greater than 10 percentage, only these two A and B will be known as, with respect to segment revenue, only A and B will be the reportable segments. If it is segment results, I have to take the absolute, right? Segment profit is 40, segment loss is 100. Therefore, I will take as percentage of loss higher is 100. So, 10% of the loss. Okay. 10% of the loss. So B and C would be reportable segments. B and C would be reportable segments. Segment loss is greater. So we select 100 as evaluating for segment percentage. So see, uh, segment result part is the formula 10 percentage of greater of absolute number of the profit or loss. Okay, and then criteria to 10% or more of the segment asset. Your assets reportable segments would be 10% or more. A, B, and D would be the reportable segments. A, B, and D would be the reportable segments. So for now, we have A, B, C, D as reportable segments. A, B, C, D as reportable segments. So I'm going to take the external sales and check whether it is forming a 75%. No, it is not forming. Only 69% is getting. So for the additional remaining around 5 point some percentage, I will take the additional segments as operating segments. Okay, even if those do not fulfill the existing criteria threshold limits. Okay. Yeah. I guess we'll catch up this big chapters alone in next video. Okay, financial instruments and consolidation will check all this important sums, and then we will have one separate video for the leases. So with this, we'll complete this video. Thank you so much. Stay tuned.